Medpace has returned 128% for the past year, and today we'll be looking at a market leader in a highly profitable market which has solid fundamentals, high efficiency ratios, and a 30% yearly revenue growth for the past 3 years. We'll be looking at Medpace Holdings, a biopharmaceutical support company. In their annual report, they say that their mission is to provide scientifically driven, outsourced clinical development services to the biotechnology, pharmaceutical, and medical device industries. Basically, what this means is that Medpace provides a range of product development services for the different phases that exist in the biopharmaceutical world, clinical trials. So they basically offer their services to biopharmaceutical companies, which are their clients. They provide services such as conducting clinical trials, conducting feasibility assessment for the different medicines that are being developed, patient recruitment and retention strategies, and risk-based monitoring. So basically, this is like a consultancy firm very geared towards clinical research and biopharmaceutical activities. Medpace competes based on factors such as therapeutic expertise, global presence, operational efficiency, and of course, their value proposition. And so far, they have been doing so remarkably. Medpace has a return on capital employed of 21%, which is extremely solid and higher than the majority of their peers. They have an interest coverage ratio of 96 times, meaning that they will not have any debt issues in the short term. They have a very good cash conversion ratio of 145%, and this basically means the percentage of net income that is converted to free cash flow, which is what we investors in the end get and receive as the return of the company. They have a very good profit margin of 28% and a higher than the industry average operating margin of 19%. This company's revenues, gross profits, and net income have been growing consistently for the past 4 years. Just look at the growth rates. The revenue has been growing at a 30% growth rate for the past 3 years, and this company is already a pretty decent sized company. So this growth rate is spectacular. Additionally, this company is not a big fan of leverage. They do have some liabilities, but their current ratio and their debt to equity ratio are exactly where they should be. Now, their efficiency ratios are through the roof. Of course, the return on invested capital here is very, very deceiving, especially since this scale is placed on a logarithmic scale. So it would be better just to focus on the return on capital employed that we saw previously, which is still above the industry's average. And when moving on to the fundamental analysis, this company gets a very solid 7 out of 8 ticks. The first one being that they have a very low liability risk. Then they are very, very good at having consistent free cash flows, which is something that I love in companies I like to analyze. They're conducting very heavy share buybacks, which is a positive for investors. And they do have pricing power over their clients. Then they do have very, very extensive organic revenue growth, as we have seen, which directly leads to organic free cash flow growth, which is great to investors. Finally, they have an existing moat and a competitive advantage since the majority of their clients that they have been working with are return clients, and it's extremely difficult that any other company will be able to compete with them based on their extensive knowledge on the solutions that they have been providing for the longest time. The one thing that doesn't tick the box for me is their balance sheet. Now, it is true that I have been very tough with them on this one, but I am a big fan of companies being able to cover their short-term liabilities with their current assets, and this company is not able to do so right now. I don't believe that this company needs to change their growth strategy since they're growing at a very fast, predictable, and resilient pace. However, I would suggest 2 different growth avenues that I suggest for the majority of the companies that we analyze. The first one being geographical expansion, which is a lever that they have been implementing so far, and it has been working great for their business. And the second one, the new offering development. Now, this is something that they have been partly doing since they have been offering different solutions to their customers. However, I would like something more innovative, especially since there are a lot of big competitors and big players which are bringing innovation to this sector. In terms of valuation, I think this company will always be trading at a hefty premium based on the fact that they have such a high revenue growth. However, right now they're trading at a PE ratio of around 45 times, which is the highest they have been trading for the past 4 years. However, their free cash flow yield does suggest that it is at an attractive valuation, as it yields 5% against the 3% long-term inflation rate. In terms of risks and possible challenges, I see competitors and regulation the main ones. Why? Well, competitor or the worsening of the competitive landscape, based on the fact that this sector has very high demand, it is extremely profitable, it has so many players, and it has a lot of innovation inside the sector, meaning that they constantly have to be adapting and evolving their solutions towards the new needs of their clients, but also protecting themselves against the innovative solutions that their competitors will be bringing to market. And secondly, the regulation one, the possible upcoming regulation changes. The biopharmaceutical sector is extremely dependent on regulations and regulatory changes. This is why I put this as such a high challenge or risk, because they will have to be constantly evolving and learning the new regulations that will be coming up and fighting against them to approve their clients' products. Now, in terms of performance and market, I do not see these playing a big part on their possible challenges or risks, because first of all, performance, they have been achieving their objectives for the longest time, and the market, an economic downturn or cyclicality will not affect the biopharmaceutical market, since even if there's an economic downturn, people will need new medicines for their diseases. So before moving on to the investment conclusion, please remember, I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I do believe that this company has a strong competitive advantage. It provides extremely consistent, predictable, resilient, and growing cash flows, and it has a higher return on capital employed, meaning it can create value for the investor. So overall, I believe that this is a great company and a great investment, especially because it's a high quality company. So thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon. There's a link in bio down below for extra content. And there's also a link in bio for a free stock if you join Trade Republic or Trading 212.